The Nuburu Inc. stock, BURU, closed on Friday, October 24, 2025, at $0.40 per share, marking a significant intraday movement that saw the stock hit a high of $0.43 and a low of $0.32, which is indicative of the highly speculative nature of this particular equity. The last recorded after-hours trade was at $0.34, representing a pullback of about 0.45% from the day's close. Now, here's the surprise. Most investors are still focused on the company's long-established identity as a pure-play blue laser technology innovator, which honestly has seen a lot of financial turbulence. But the real story, the one that should force a deep reevaluation, isn't about lasers anymore. It's about a radical, aggressive pivot into the defense and security software-as-a-service SaaS market, effectively turning the company into a defense tech hybrid. This unexpected, almost desperate-sounding strategic shift creates a deep tension between the company's past and its stated future, a tension that is currently fueling the stock's wild volatility, evidenced by a staggering one-month return of nearly 190%, even with the low absolute price, suggesting a major sentiment-driven trade is in play, primarily among retail online investing enthusiasts who are often looking for the next big parabolic move in a micro-cap name. The common market belief about Nuburu stock has been shaped by its history, a small-cap hardware developer struggling with commercialization, high operating expenses, and a challenging cash burn rate, which resulted in a prolonged decline and the fear of delisting. Just over a year ago, the stock was trading near a low of $0.12. The underlying product, high-power, high-brightness blue lasers for welding copper, aluminum, and other reflective metals, crucial for applications like EV batteries and additive manufacturing, is technically sound and provides a genuine competitive advantage in terms of speed and weld quality. However, superior technology doesn't always equal financial success, especially when competing with giants who control the supply chain and established markets. The reality, which few have fully processed, is that the company's new leadership is actively dismantling the laser-only expectation. They are executing a transformation plan, primarily through a series of acquisitions and strategic alliances designed to create a completely new defense and security hub, which they hope will provide a stable, recurring, high-margin revenue stream to offset the capital-intensive laser business. This isn't a minor diversification, it's a complete change of narrative, and it's forcing the market to price the stock not on its historical losses, but on its potential as a defense contractor and SaaS provider, albeit one with a fraction of the market cap and balance sheet strength of established players like you'd find trading on a platform like Interactive Brokers. Let's zero in on the recent stock movement. The massive volume we've seen accompanying the price swings, like the over 10 million shares traded in a single session reported in the data, isn't typical of a fundamental shift being priced in. It's the signature of speculative trading. The share count and the low price point make this a fertile target for short-term retail self-investing pushes, where news, even a compliance warning from the NYSEAMERICAN about a dual CEO announcement, as we saw recently, can trigger massive but often unsustainable moves. Institutional ownership, while present with names like Vanguard and Geode Capital, is still a minuscule fraction of the total shares outstanding, underscoring that the smart investment funds haven't yet bought into the new story, or, more accurately, they haven't seen the necessary revenue and margin traction to justify a substantial position. The institutional presence is mainly due to passive Fidelity mutual funds or Fidelity ETFs that track the extended market. The market's excitement stems from a series of high-profile announcements, the formation of Nuburu Defense LLC, the agreement to acquire Techni SPA for vehicles and defense electronics, and the plan to finalize the acquisition of Orbit SRL, a SaaS company focused on operational resilience. The market's expectation is that these moves instantly grant access to a projected $3.6 billion U.S. defense-grade SaaS market and an electronic warfare sector projected to hit $19.4 billion by 2028. The reality is that these are agreements and plans. The actual integration, synergy realization, and revenue consolidation are still in the future, and historically, small-cap companies executing such a dramatic transformation through acquisition face significant execution risk. The negative consensus from analysts, evidenced by a strong sell AI score in some models, and concerns about declining historical earnings and revenue, is the counter-narrative that the optimists are currently choosing to ignore. To fully grasp the core business, we need to briefly revisit the blue laser segment. Nuburu's blue laser is genuinely differentiated. It operates at a specific blue wavelength that is absorbed much more effectively by common industrial metals like copper, a critical material in the accelerating shift toward e-mobility and energy storage. This means faster, cleaner welds, less scrap, and higher manufacturing throughput, which are huge selling points to manufacturers in the EV batteries and aerospace sectors. However, the commercial scaling has been slow and costly, which is why the financials, total revenue consistently low and net losses increasing, paint a stark picture. The old business model was a typical high-tech, high-capex play, requiring constant R&D and a significant capital base. The new model, the Defense and Security Hub, is an attempt to piggyback on the high-margin, sticky revenue characteristics of a SaaS model. This is a clever maneuver, aiming to create a two-pronged company, a slow-burn, high-potential blue laser hardware arm subsidized by a faster-growing, higher-margin defense, SaaS, and services arm. The successful execution of a $6.6 million international contract through the Techni partnership is a key piece of validation the company is offering to the market, and one of the catalysts that started the recent upward price momentum, creating the tension we see today. Looking ahead, the future outlook for Nuburu stock hinges entirely on the success of this metamorphosis. The company anticipates generating initial billings of approximately $500,000 in Q4 2025 from the Nuburu defense segment, which, while small, is positioned as the foundation for a significant upward trajectory in 2026 as the acquisitions are finalized and consolidated. The key catalyst is the successful integration of the newly acquired entities and the subsequent securing of large, recurring government and enterprise defense contracts. If they can demonstrate real top-line growth and margin expansion from the SaaS component in their next few earnings reports, the expectation of a successful pivot will be met with reality, and the stock could sustain a higher valuation. The risk, conversely, is substantial. This kind of aggressive M&A strategy is complex for even well-established firms. For a micro-cap company with limited cash, approximately $6 million reported recently, and a history of financial strain, integrating foreign entities like Techni and a domestic SaaS startup like Orbit while adhering to all regulatory and compliance requirements, including those from the NYSEAMERICAN, is a tightrope walk. Further capital raises, which would likely be dilutive, are all but certain. Investors using platforms like Robinhood or SoFi Invest need to be acutely aware that the short-term speculative hype is currently divorced from proven long-term financial stability. It's a high-stakes bet on Executive Chairman Alessandro Zamboni's ability to execute a complete corporate rebranding under intense financial pressure. You might be considering whether it's worth the risk to buy in, or perhaps you're using a low-cost automated platform like Schwab Intelligent Portfolios and are wondering how such a volatile stock even gets on your radar. In summary, the expectation that Nuburu is solely a struggling blue laser company is fundamentally outdated. The reality is a high-risk, high-potential speculative play on a desperate but audacious pivot to defense tech SaaS, evidenced by the massive recent spike in stock volume and price. While the original blue laser technology is solid, the company's financial survival and ultimate success now depend on its ability to rapidly assimilate its new acquisitions and deliver on the promise of recurring high-margin revenue from the defense sector. The tension between the low-revenue blue laser past and the high-growth SaaS future is what we're watching. For the savvy individual investors seeking investment help, this stock presents a classic binary outcome. Execution leads to a multi-bagger return from its current low price, or failure to integrate and raise capital leads to continued financial distress. The huge institutional inflows haven't materialized, and the volatility is a clear sign of retail sentiment driving the bus right now. Comment below how many shares of Nuburu stock you currently hold, or if you prefer the comparative stability of large-cap tech like Apple stock or Nvidia stock. The coming quarters will tell us whether this dramatic corporate shift is a lifesaver or simply a last-ditch effort. Finance disclaimer. This video is for educational and informational purposes only and should not be considered financial advice. Always conduct your own research or consult with a licensed financial advisor before making investment decisions. Like, comment, and subscribe reminder. If you found this video helpful, don't forget to like, comment, and subscribe to stay updated with more stock market insights and daily analysis.